Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our Tuesday last class of the day, Building a Stock Portfolio. I am your host, Kevin Horner. I want to thank you all for joining me this afternoon. Pleased to be joined by Ben Watson here in the chat. You can say hey to Ben. You'll get to comments and questions I'm unable to. Ben, a wonderful coach, of course, a good friend of mine, and knows all that we'll be covering here in today's class as well. So feel free to ask questions. I'll try to keep an eye on things there also, and be sure to bring those to our discussion as is pertinent. Today, as is usually the case, we are going to run through our example portfolio, maybe not hustle, run through it. I'm going to talk about a couple of trades that went off in the last week. We've moved out of a couple of positions. We've moved into a couple of positions. We're going to start with new example trades for the following week as well, based on what the opportunities may have presented us in the market here over the last week. So after a very brief look at the close on the market today, we'll get to the example portfolio, follow it up with example trades for the following week. All right, with that, additionally, make sure you're following us on X. I'm available there, Kevin Horner CS, Ben, of course, Ben Watson CS, and try to provide for you there weekly some good charts, some things to keep a close eye on. Today I was posting a little bit about oil having rallied back into the gap level we had from last week, kind of an interesting spot, and around 94, 95. We'll talk about that on the chart too and take a look and see what's going on there. We had a little bit of pressure, but you'll see it. The pressure did not persist as it relates to some of the high-flying groups that we've seen of late. So with all of that, let's get to our disclosures so that we can jump in to the chart. So first of all, remember, everything we cover for you today should be considered informational and educational only. We do not make any recommendations here. What we are offering up, though, are concepts and strategies via technical analysis that traders may choose to employ. My encouragement to you, if you like any of these suggestions, is to customize them to your comfort, your tolerance for risk, the way you like to trade. But ultimately, what we're recommending, as always, is a process. And here in this class, that process I will call out as we work through it in upgrading, or rather elevating, our stop orders on our long example trades, and also in the manner in which we build new example trades where we do follow through, of course, a pretty strict process there. So that should cover us for our expectations for the class, at least. Let's check on a couple more details here as the agenda. Like I mentioned, we're going to basically bring these concepts to bear every time we talk about a chart. So everything you're hearing from me is going to be an analysis of that chart, look at the price action, and perhaps a discussion around our existing position that is giving us that topic. So how are we going to manage it? What kind of things may we want to change? That kind of stuff. So with that in mind, we're going to take a quick look here at how we finished the day. The day today was largely green, though we did not move aggressively outside of the S&P, the semiconductors, as you can see here. But the S&P 500 continues its trudge higher. We've kind of gone a little sideways, a little neutral over the last 4 sessions or so, but by no means breaking down, as you can see. Ultimately, I think what a lot of traders are looking for is a consolidation akin to what we got here in mid to late April, then that allowed us to continue the move higher. If you're that trader working with the 20-day simple moving average, which I have applied in orange here, then you've not been provided a reason to move on from the trend. The trend has been your friend since April 1, and the S&P 500 has treated you well. If you've just decided to stick with it, you'd be up about 20% plus. Now, the same thing can be said about the NASDAQ 100 here. We've got a little bit more volatility, but a similar move working with the 20-day moving average. Our rally here about 34%. As always, know the levels where you want to move on. Do not be surprised by pullbacks that exceed what you deem to be support. Always be considerate of what should be the next level of support, or at least an area that you might think gets tested if we get a break of a level of support. Commonly what we see happening, of course, in terms of trend management is traders will be too tight with their exit strategies, too in line at the area of short-term support. They want to give more wiggle room. We do that with a use of the ATR, the average true range, which we will expand on, of course, as we talk about our example portfolio and new example trades. But ultimately, you do want to give the index, the stock, a little bit of wiggle room through those moving averages, but the amount of that wiggle room is really up for you to define. So consider that part of your process as well. Russell 2000, our best of the big three today. Notice how we've held that horizontal breakout level this week. I think bulls would be very pleased with the fact that we've gotten that pause in price, essentially just trend taking a breather. The trend hasn't continued aggressively to the upside, of course, but we've held that horizontal support, and that can give bulls a little bit of comfort. Additionally, you'll notice the 20-day is catching up here to that breakout spot. So maybe we're back into trend where we can rely on the 20 as our short-term support of the current trend here. Now the semis just continue to be aggressive to the upside. Try not to fight against it here. The move in the semis has been tremendous, as you all know. Our April 1 bottom back here, let's just measure it to today's peak, which was nearly 6%. We're at 93, almost 94%. It's an unbelievable move. Again, from a trend standpoint, everybody, the thing about technical analysis is that this level of what I can only call a little bit of silliness due to the speed of the trend, it can persist. It continues to confound the non-believers. And until we get to the point where the non-believers say, fine, I'll buy this trend, that is when we will start to see the pullback and the breakdown. It's going to take some time because the denial of the uptrend continues to persist. If you are watching social media, if you're just listening to what's going on out there, you still see individuals who want to bet against what they're seeing in the semiconductors, not believing it, and thus not participating. The way that's going to go, most likely, at least this is the way that I've seen it go on in my 3 decades of watching the market, is the moment that the people who aren't believers become believers is when the easy money is no longer to be made. So we're going to watch and pay attention to those instances of the conversation around the broader markets here being way too exuberant, like, okay, now this market can never go down, etc., those types of comments. You know, we still haven't seen that yet, especially not relative to semiconductors. And the thing about it, the thing that is so tough for so many of us is not that we can expect that to happen, right? But that it takes a time frame that is not consistent with when we think it should happen, right? So I'm a big believer in, and I think a lot of technical analysts are essentially watching trend and not fighting against it. You don't have to be bullish yourself. You don't have to buy into these bullish trends if you're uncomfortable. But at the same time, don't find yourself bearish in bullish markets. That's very difficult to sustain, and that can obviously wipe you out. So be attentive to that. You can be bearish by being in cash. Nothing wrong with that. I'm going to snap another line up here, everybody. I'm going to move it just to another level because when we have gaps, we all know gaps can act as support, everybody. Very important for us. So, all right, so there's your brief market look. Let us take a look at our monitor page and more specifically our account statement, which I have sorted for the last 7 days. So basically just going back to last class, and I'll remind you, of course, our archived footage here is a great way to just kind of track along with how we're doing in this class. We did begin in January. We've had some trades go against us. It's not a perfect process. No market trading process is. But what we've been able to do largely is sustain some positions longer through a couple of key trade management processes. And we'll expand on that here a little bit more. Now, what we've done in the last week, I want to talk about our sales. We had a 5-share position in Eli Lilly. That trade worked in our favor. We got to the limit level and we were able to sell it. Let's look at how that trade went for us. We actually placed, I'm going to go back into my gear here and I'm going to show the trades. So we actually bought in here on this breakout. The breakout that I'm talking about is the one that gave us a move off of the 50-day, kind of a double bottom short term at the 50-day. And then we were thinking, hey, we could break to the upside. And boy, on the day we bought it, we sure did. And it got us into the trade. And we had a bracket, meaning we had an exit above and an exit below with a stop order. In our case, we were able to sell at our limit up here at 11.10. So we did pretty okay on this trade. We just turned it a bracket order, protected along the way, raised our stop where we could, and we got taken out of it when we gapped and moved through resistance. Interestingly enough, the stock has now pulled back a little bit from that, right? So at the point now, we could be talking about Eli Lilly once more, but I think given the trend, we could also be a little bit patient and might even be able to get into this one potentially even next week, even though it would make our standard list for potential healthcare positions because it is trading above its 20, above its 50, and above its 200-day moving averages. So some traders might give this one a look once more. Okay, so that's what happened with Lilly. We had a good trade that went our favor. Let's take a look at Halliburton. Now, Halliburton's a fun one because we've actually built this one out as a trade of multiple exits. I really enjoyed this one because I think it highlighted the ability of a trader to kind of shift and move with the market. So what did we do? We had a 275 share trade. We bought in on a 50-day test here. We got a hold, and we bought the next day following the close above the high of the low day. So essentially, we wanted to be a buyer based on a test of the 50-day. We got in, and then we were pushing this with a standard stop order along the way. But we also targeted, we wanted to get into this $42, 41.5 area to take profits. But we only did so on 175 of our 275 shares. Let me show you why real quickly here. This was the weekly chart. And as you can see on the weekly, we had rallied into this level in the 41, 50, 42 in the past and have pulled back in doing so. So it made sense from a management standpoint to take some of the position off. So we did exactly that. And then we put on a good till canceled trailing stop. And that trailing stop got executed this week on the day we pulled back to the 50-day and horizontal support. Now, this one, once again, this one could be another opportunity for the trader who wants to get back in. We had the low day here 2 days prior, so last Friday. And then today, we've closed above that high. Yesterday was a little less convicted in that close. Today, much better. So some traders would look at this and say, hey, I'm ready to go again, and that would be perfectly appropriate for the short-term trader if they wanted to do an example trade on that. But in our case, we're not above the 20-day, which is our standard when we're looking for opportunities. So we won't find this one on our example list for today. But that trade worked out, transitioning from a basic stop after having sold for profit up here, basically selling 2/3 of our shares. After having done so and moving to the trailing stop, we did get taken out even though the trend hasn't broken. So that's the only true negative of the trailing stop order, everybody. It will work to help you protect any capital you have. It doesn't guarantee price, of course, because it does transfer from a trigger price to a market order, but you can at least be assured that you're taking steps to protect your capital. It's the one drawback, though, that you didn't break the trend here, or you have instances where the trend truly doesn't break and you're out of the trade. Not every trader is going to have that comfort in re-entry of a position they've just recently sold. But if you can ignore the that bias to not re-enter a trade, just because you don't want to, or maybe because you're not as comfortable. But look again, I mean, the 50-day moving average held support, did not make lower lows, matching lows, cool, lower lows, not so much. So, this one certainly could still be an example trade for some traders. All right. So that's the Halliburton trade. Let's go to our new monitor tab, or our new trades that we did put on this week. We've got one in NVIDIA, we've got one in Synopsys. Although the Synopsys trade is not for this class, I've been applying that in my trader talk on Thursday morning. So put a pin in that one. Come back and visit me Thursday morning at the open of market. We'll talk about Synopsys then. Let's take a look at NVIDIA, which we did place last week. So NVIDIA for us, let's see here. There it is. So NVIDIA, we got in on a break of our, basically the pullback level. Now the 50-day is in play here, but it was the 20-day that was really the key detail. And we went ahead and got in. Oh, I'm sorry, everybody. This was, we got in back here. So we got in on a buy based on the movement on the 26th. We were hoping to hold the 20-day. We placed a padded limit and we got in, and we had a stop order right away, which is where we reside today. But the stock has moved in our favor since then. Now the question becomes, how do we manage, and what level are we going to work with here in deciding our new stop order? Or do we just basically stick with it, because we have the stop set at 203.58. Okay, let's do a little bit of math on this. Normally we would look at the 20-day moving average in orange. Today it's 217.97, and then we would come below it by the amount of the ATR. That ATR today is 833. So from 217.97 minus 830, let's going to round that up a penny, 834, we could have our stop at 209.63. Okay, and we're at 203.58. So I'm basing that calculation off the 20-day moving average, below it by 1 ATR. This is just an understanding of the current volatility, essentially, as it relates to NVIDIA. And this gives us a greater likelihood of maintaining the position through, standard intraday machinations that you will find. It doesn't guarantee anything, of course, but it is a decent way for us. It's been working with a lot of our positions in trend here. As long as we select the proper moving average, we could be capable of maintaining this position for a while. So we'll work with the 20-day. I wrote that down, 209.63. But I want to point out, if your preference is the 50-day, yeah, given where we are entered, we've got a bit more risk, right? I mean, even if we went just below the 50-day, we're looking at about a $12 loss on our trade. By moving it up to the area that we're thinking about, though, guys, we're going to be looking at about a $3 loss potential on the trade. Obviously, can't guarantee it, but that's something we should be probably comfortable with given the size of our trade. But as always, think about the other levels, do the math, know where you would move on, and then just pick the one that gives you the greatest amount of comfort. And don't hesitate to think about these as layered exits, so you don't have to do full position. You could always make an adjustment along the way that says, I'm going to change from the exit of 40 shares, I'll leave 20 at this current level, and I'll add 20 higher up. Something like that is another way that you could consider it, as always. So we're going to go ahead and just raise this up, like I said, 209.63 on the NVIDIA trade. And just confirm good till canceled, good, and now we're good. All right, so raised our stop on our example NVIDIA trade. Let us go back to the monitor page and see what else we've got working here. I've got them all over here on my watch list. We've got some big ones here. In fact, I want to highlight the current visual on these, but let's just go ahead and start with the biggest and best one thus far. It's HPE. Our returns on this have been dramatic thanks to a massive gap up, everybody. So we've got 200 shares at $24.55. Stock is trading much higher today. Let's take a peek. So we are looking at a 100% profit situation on this one, everybody. So obviously we want to protect ourselves. We know we need to raise the stop. We can consider the gap level to be an excellent spot. And to be perfectly honest, being that we have made and achieved a 100% plus return, the way to manage this that makes the most sense to some of us traders is to take half of the trade off the table, right? Sell 100 shares of our 200, take back the capital we devoted to the trade, and the remaining shares are 100% profitable. We don't have to sell them. We don't, in theory, even have to protect the position thereafter if we sell half, because we've removed all of our capital that we put into the trade. By selling half, we have all that upside, and the only way we could turn that into a loser is if the company goes to zero, right? And so that's one consideration. The other thing is, maybe you traders are saying, yeah, there's a couple of ways. I'll sell half tomorrow to capitalize on this. Maybe I'll sell 10 or something. If it breaks this gap level, maybe I'll sell another 10% if it broke this gap level. Some of you would want to ride a very short-term moving average. I kind of like that 10-day, given what we've seen here, everyone. Held it since April 15, and it's catching up to this gap ledge. So some of you might even look at 41 and just say, yeah, that makes great sense. Under that, I think it would make sense to reduce the position size further. For our purposes today, let's go ahead and take a fairly basic approach. Let's keep our stop order, a basic stop order, 1 ATR beneath our gap. Let's go with the belief that what we've got here following earnings is a true gap and go situation, but we're going to sell half tomorrow morning. So job one, sell half tomorrow at open. Secondarily, raising our stop to getting an ATR below the low. So let's do the math on that. The day's low on HPE, low is 53.47. So we'll go 53.47 less the ATR, which is 343. So we're going to go in at 50.04, but that's so close to 50. Let's just go like 10 cents beneath that. So like 49.94, which is still going to keep us in a max profit. Oh, I need to make an adjustment to this. So sorry, everybody, I'm going to change this. Since we're going to only raise a stop of 100 shares, we're going to have to do a cancel replace, change this to 100 shares. Good till canceled stop at 49.94. All right, so we'll make that adjustment there. And then go back to our, let's see here if I can just do a sell here. So we can do a limit sale, but my biggest concern now is just getting those dollars out of the trade. I am not as concerned with where it opens. I'm working to get this trade completed. So let's go ahead and sell half at market tomorrow morning. That's what we'll get out of this here today. So selling 100 at the market open. Now, as a reminder, that means I can't have any guarantee of price. If this thing opened at 40 tomorrow and I lose 16 bucks a share, so be it. But I do have that risk, okay? So keep that in mind. All right, so we're going to sell 100 at the open tomorrow, hopefully take a 100% profit on those 100, and then ride our stop for as long as we possibly can. Maybe we can turn that into a trail even later, but for now, standard stop it is. Let's take a look at the rest of them. Well, I mentioned Synopsys. Oh, the other one working really well for us here is the Morgan Stanley trade. We got in on a lovely candle tail through the 20-day here, followed by a close above the high of that low day at least. Very short term, that is. And then we just broke out over the last 2 weeks. So this thing has been moving. Here we're going to work with either the 20-day or the 10-day. Now, the 20-day has been clean. Let me clean this chart up so you guys don't, I think this will be a little easier to see when I get rid of my orders and positions. But look at the 20, has just been really, really clean for us since we got it again back in end of March. So basically rallying with the market in April, looking strong. We can use the 20-day, but guys, we're giving up 17 plus a share. That might be too much for some of us. So just as a reminder, do the math on it. That's 9%, right? So not terrible by any stretch, especially in a profitable trade. And in this case, our profit is solid on Morgan Stanley here. 972, not a bad trade at all. So this has worked really well, but this is all going to come down to, as always, once more, where do you have the greatest comfort? Are you that trader who likes to sell into strength? Or are you the trader who says, no, I'll wait for the stock to break down. Maybe I'll use the 10-day moving average instead. But even the 10-day is 12 points away, everybody. So we got to give up some semblance of our profit opportunity for the opportunity to stay invested. Now, in the scenario where we are at all-time highs, and we are here at all-time highs in Morgan Stanley, hey, what are we supposed to do other than let it go? We don't have a ceiling. If there's no resistance, it's just about where traders will allow the trend to take its pause. One way we can do this, just to get an idea, we could do a Fibonacci extension from the prior high, which we broke, to the upside, kind of draw it in like so. Let me pull this down so we can find it. There it is. So if we get through, see, 216 becomes an excellent area, doesn't it? This is one way that some traders will look at this as a target. They'll say, all right, well, we made it to that first extension of 161.8. Maybe that's a spot where we take a little bit of profit, or maybe that's a spot where we raise our stop nice and tight. A snug stop level might be below the low of the week. So the low of the week is 206.60. But again, if we incorporate an average range, well, you're going to find an ATR on a stock of this size on a weekly chart to be pretty big, 1150, right? So we got to give a lot of wiggle. So as always, we have some thoughts, we have some ways to do it. I want you all to just be thinking about those concepts so that you can make the decision that's best for you. Am I that trader who wants to take a little bit off up here and let the remainder run? Maybe so. So let's see. We've got the position size of only 40 shares. It's not massive by any stretch. But why don't we look to sell 10 at open tomorrow, because we are at that 161.8 extension level. And then let's give the rest of it some wiggle room down to the 20-day with an ATR. Okay, so what I'm recommending here for our example trade today, let me lift this here, clear out my Fibonacci's. So what we'll do is we'll sell 10 shares tomorrow at, well, let's see if we can't get out at about 215. We'll put a limit on it, and then we'll hopefully get out of that at 215, or 10 shares at 215. So that's the first thing we're going to do. Let's go ahead and do it as a sell with bracket. So this way we can be fully in control, I believe. So we've got 40 shares. So let's make this 40. All right, no, we're not buying here, actually. Hang on, gang. Let me see. Here we go. Yeah, so here it is. Create closing order from our monitor tab with OCO bracket. So this is going to allow us to sell at above 215, which is what we'd be fine with. So I'm going to just make it 215, limit for tomorrow, okay? And anything over 215, we're going to sell 10 shares. Now, on the stop side, we're going to do the math on that and change that to a good till canceled order. And it's not going to be 40, but it's going to be 30, okay? And that's because what we're hoping for is to see those 10 shares get executed right away tomorrow morning, right? So that makes sense to me. Now let's do the math on that. We're going to go the 20-day at 197, and the ATR is only 473. All right, so 197.62 minus 473 puts us down at 192.89. So we'll come back here. All right, 192.89. Good till canceled. Why won't that let me? I wonder if it wants the bracket good. There we go. It wants the upside good till canceled as well. So to protect it here, I got to make them both good till canceled. But let's go ahead and get that on the platform so we can see it. And not available to borrow, but I've only got the 40 shares. I don't have an exit on it. Oh, I did have an exit. Sorry, gang. Of course. Let me do that one more time. I apologize. I've got to cancel that original order, so I got to replace it. My apologies, gang. Yeah, because the system says, oh, wait a minute, you've already got the sell order on that, so we can't put it in there. So again, we're going to go create closing order, OCO bracket, we'll sell 10, and then protect the remainder here of 30. Again, 10 is at our 215 limit, and then on our stop, it's 192.89. All right, good till canceled on both. There we go. All right. Now, Morgan Stanley. All right, next up, VeriSign, VRSN. Trade going well here also. That one's moved in our favor quite nicely, 35 shares. And let me put those order details back up. There we are. So it has moved up well. Probably not a big adjustment on this one, everybody. The 20-day moving average today, let's find out. 294.05. And then our ATR is 918. So that would mean 284.87, and we are in at 280.23. So let's just rally this up to 284, close to 284.87. All right, that's going to look like right below it at about 284.75. That'll work. So that's close. Remember, though, I don't like those nickels, but we're below the ATR amount, that ATR calculation. So let's go ahead and hit that, and we are in protective mode on that one. Now, I saw your question here, Jim. Do you ever use an ATR for a weekly basis versus daily? And the answer to that is absolutely. Just comes down to the time frame for your trade. If you're not looking at weekly charts to base your decisioning, well, then you probably don't need ATR on a weekly basis to make your decisions on exit strategies, right? Always tie your preferred exit strategy to your preferred time frame. And so sometimes, in fact, I think even today, as an example, in the last week, what I've been doing is letting my stocks rally and run. And then when things get a little undecided or it looks like selling is working its way in, what I've started to doing is going to my hourly charts, elevating my stops into hourly areas of support, with the idea being that if it breaks down here in the short run, I'm really moving on very quickly, taking profits, getting to cash, continuing the process once more, looking for my next opportunity. That's not going to be for everybody, but that's the way that I've found that helps me manage the profitable trades. I'm always looking to sell for profit as best I can. If I can sell for profit more consistently, chances are I'm going to be doing better in my process. But ultimately, lean into the one that fits your time frame, Jim. So if you're trading based off weeklies, yeah, you can absolutely incorporate ATR on a weekly basis in building your exit strategies. Okay, EW. EW has worked out well for us a couple of times. The reason being, I think we have unloaded EW. I think we've done a couple of trades here. Yeah, so we had one of those scenarios again where we had the bracket, everybody, where we bought in, held, and then sold half when we rallied into resistance. Well, now we're almost breaking through resistance. In fact, if we looked at this trade over simply just the last few months, as I zoom in here, what you'll notice, yeah, this looks kind of like a cup and handle with a double bottom, doesn't it? With our bottom right here, another bottom right here, cup, and the high handle, higher than the left side of the cup, but still, you've basically got a handle created up here. And a lot of traders would look at this and say, well, we can go long when it breaks the highest high that we've seen in the handle, that being the pivot of the cup and handle, and they want to get long on a breakout. So maybe there's a trade here, to the upside further, and it could be running, but where we are with our stop, it's pretty close to the 20-day moving average, happens to be just beneath the 20-day moving average in orange right here. And that's based on the series of last lows. So we're going to let this one go. We've sold some for profit, thumbs up to us for matching our process. And now we're just going to hope that this does rally forward, in which case we would be able to elevate our stop next week, potentially. All right. And then the last one on our existing examples here is CleanSpark. CleanSpark rallied for us beautifully. It made a short-term high. We want to stick with it. We've been working with the 20-day. The 20-day today is 1538. Oops, I got one too many of those ATRs. There we are. $1.27 in the ATR, and our 20-day is 1538. So minus the ATR, right, of $1.27. So 1698 minus $1.27 means we can go to 1571. And would that be above our breakout? It would be above the breakout. So, you know, in this kind of a scenario, everybody, I think a lot of traders, being that we have the breakout level and we're below it with our existing stop, I think a lot of traders would stick with the existing stop because any pullback could easily revisit the breakout spot. Okay, and I think a lot of traders would stick with it. So we'll see how that goes, everybody. All right. Let's see. Next, let's get looking at some new example opportunities, potentially at least. So I had a couple of those. We'll get our final 9 minutes or so here for you all. I'm going to go add back all my major moving averages. I've been looking at a couple of potential groups. One group was staples based on a bounce off the 200-day moving average here today. We did make a lower low today. We have a doji at support, indecision. Not all that uncommon to see a doji after some selling like this. This could be an area where traders would look to expose some money into staples. Having said that, what I did was could load up our existing the uptrending all time frames staples group. So again, everybody, this is utilizing a scan I've built that is very basic. It's looking for stocks that are above their 20, above their 50, and above their 200-day moving averages with a sufficient amount of volume to enter and exit our trades. Here, I had one that fell apart, it looks like. I was all excited about Dollar Tree, but it did not close, or it closed on its 200-day. I think that's going to be close. We are a penny below the 200-day, everybody. Boy, I mean, it takes a lot of discipline to just sit with this and say, nope, it didn't hit it. Or it didn't close above it. We're going to go with it. I thought this was an interesting chart for a number of reasons, not the least of which is the most recently broken downtrend, gap higher following earnings. So, the entry here in this zone with maybe an ATR beneath the lowest low following the gap. So, here, we're going to look at Dollar Tree. We're going to do entrance, and we're going to use 110 as our entrance figure. And I say figure because that means that's what we're basing our exit valuations against. So if we're in at 110 and our low is 106.40 minus the ATR on the stock, which again is 555. Well, then that means we're going to be looking at somewhere in the neighborhood of about 101. And 101 would be slightly above the 50-day moving average. Some of you would say, I don't like that. I don't want to be below the 50-day. Some of you would say, it doesn't bother me. But make sure you're doing your math. You're building the trade the way that you would do so. But we're going to go ahead and incorporate 555 below 106.40. Okay, so 106.40 less 555 gives us 185 cents. And if we get entrance at 110, we're going to use 110 as a limit. Well, then we're risking $9.15. Okay, now we have to do the math based on the highest price we'd be willing to pay. That way we are always comfortable with the share amount. So if we're risking $9 a share, $9.15 as it is, We can't lose more than 1,000 on the trade. That's our target for loss. No more than that keeps us within our comfort, within our tolerance. So we'll just take $1,000 and divide it by 915. And that tells us we could own as many as 109 shares. For ease, we'll go with just 100. So here's the way we'll do it. We'll right-click everybody. 100 shares is going to be, oh, I can't go with 100 because that's bigger than my $10,000 maximum. So we're going to go just a little lower. We're going to go about 75, okay? So just trying to use round figures, making sure we don't exceed our tolerance and so on. So we're going to buy custom with bracket. And we are going to try and be a seller on this one if it rallies back to the last level, approximately about 135. That would give us about 20 points of upside for maybe for that $9 of downside. So about a 2-to-1 reward versus risk. And again, we're going to go 75 shares here. All right, so 75 at a price not to exceed 110. And then our limit is going to go up here at 135. Is that what we said? Yeah, 135 as a good till canceled. Now, this all assumes that we get into this position tomorrow. We're going to leave that as a day-only order. And then our good till canceled stop is again in at 185 cents. But I don't like that 85, so we're just going to go beneath it. How about 77 cents? All right. So 75 shares in, 75 out at 135 or at $100.77 on a stop, or although we know that's simply a trigger and cannot guarantee price. All right, there we go. So there's our trade for next week. Just wanted to give you guys the idea. The other thing that I was giving consideration to here beyond staples was industrials. And the reason is, as you can, I'll show you the industrial chart. The group has managed to hold in quite well above the 50-day moving average here. Lots of positive development following the gap higher with April's move. And therefore, you'll find some interesting symbols in this group as well. So just wanted to give you all the reminder that there are other groups moving, okay? And I did do a little bit more homework, but I just don't have the time to share it with you all today. Alera, I did see your KDP position. It definitely made it to my list, as you can see. This is one we've been monitoring as well. Also in the process of possibly busting out of a range. This nice little bull flag is filling out the flag here now and trying to get up into the last level, and that last level is somewhere in this vicinity on KDP. So yeah, it definitely made the list for potentials examples here. This is certainly an intriguing chart, and it's moving through an area that it has needed to get through, so that kind of stood out as well. I totally agree with you. But gang, let's go ahead and wrap it up there. I will be back with you all tomorrow morning for Trader Talk, though. We kick that off at market open, 9:30 a.m. Eastern, with the ringing of the opening bell. Tomorrow is Wednesday, so I'm joined by fellow Schwab coach Brent Moores. We'll look forward to seeing you for that. Make sure you're following Ben and me on X, Ben Watson, CS, Kevin Horner, CS. You can also find us there on LinkedIn of late. We do try to post for you there as well, though mine tend to be a bit more consistent on X, but I am trying to get to the LinkedIn side of things as much as I can. As always, I really appreciate you all being here and sticking with me on these trade ideas, and look forward to following up with you next week. If you're going to be out this weekend in San Diego for the technical analysis and options workshop, of course, make sure you stop by and see Ben and me at some point in the session. So with that, have a fantastic rest of your Tuesday, everybody. We look forward to catching up with you again real soon.